Now that we saw how to compare assets by plotting them on a two-dimensional graph where the y-axis represents the asset return and the x-axis represents the asset risk, let's try to think about what would happen in a portfolio. Let's say we have stock A here and stock B here with a higher volatility and higher return. What do you think would happen if we start mixing the amount of money we put towards these two stocks in a portfolio? Let's say we wanted to build a portfolio with 100% of our money in stock A. Obviously, the portfolio would fall exactly at the space where stock A is currently. Same thing if we put all our money on stock B. But what is your intuition for a 50-50 split? Meaning I have 50% of my money on stock A and 50% of my money on stock B. Well, most people would say we would have a portfolio falling somewhere in a line between these two stocks. So in this red dotted line here. But this intuition is wrong. And this is one of the key insights of modern portfolio theory. In reality, the portfolios created by mixing stock A and stock B would fall on a hyperbola curve pointing to the left side of our graph here. And this is an amazing discovery. To stress that point, imagine that by mixing these two assets, we could create a portfolio at this point of the curve here, which would have a lower volatility than any of these two assets. This portfolio is actually called the minimum variance portfolio, or MVP. And to understand why this is happening, we have to look into the formulas for calculating portfolio return and portfolio variance. So here are the formulas for a two-asset portfolio. In terms of notation, we have WA here representing the weight on asset A and its expected return, and WB representing the weight we put on asset B and its expected return. So we can easily see that for the return of a portfolio is a weighted average of the return of the assets. So a portfolio with a 50-50% split between stock A and stock B would fall exactly in the middle here in terms of its return. But what happens to variance is we have an extra component here in the end, which is the correlation between stock A and stock B. As we know from statistics, correlation is a number between -1 and 1. And if stock A and stock B had a perfect positive correlation, this number would be 1, and the effect, the hyperbola effect, would be eliminated. Meaning any portfolio built by mixing two stocks with a correlation of 1 would fall on a straight line here. But as this perfect positive correlation decreases, the portfolios would fall on a hyperbola curve pointing to the left. And as the correlation decreases, it approaches the y-axis of the graph here. And this would be a point for two assets that have a correlation of -1. This understanding can shed some light on why investors look to add assets with low correlation to their portfolios. Because obviously those assets can contribute to reducing the overall risk of the portfolio, as we exemplified here with our MVP case. Let's continue our understanding of the theory by introducing a risk-free asset to our graph here. As you can see, the risk-free asset falls on the y-axis of the graph, meaning its standard deviation or volatility is 0. As you remember, for a risk-free asset in any up or down state of the economy, the future value will be the same. So you can think of this asset as something like a short-term treasury bill, which is known to be very safe. We can create portfolios by mixing the risk-free asset with stock A, for instance. And all these portfolios would fall on a straight line between the risk-free asset and stock A. To understand why this happens, we go back to our portfolio variance formula. And imagine that instead of B here, we have F for risk-free mixed with the asset A. Since the standard deviation for the risk-free asset is 0, we eliminate this part of the equation and this part of the equation. And that is the reason why the portfolios would fall on a straight line. We can also mix our risk-free asset with stock B and create portfolios that would fall on a straight line between RF and SP. The same is true for any portfolio that we choose here on the hyperbola curve. And as we choose portfolios going up on the curve, the angle of the line between RF and these portfolios would increase to a limit here touching at the tangency of the hyperbola curve. And this portfolio is known as the tangency portfolio. For this characteristic, rational investors would choose the tangency portfolio as their risky portfolio. And if they need to reduce the risk, they would mix some risk-free asset to their portfolios, therefore walking along this line here. You might be asking, is it possible to go up here on this line by increasing the risk? And the answer is yes. You could short sell risk-free and invest it in the tangency portfolio. In reality, there's a spread here between the borrowing rate and the investing rate, so this line would break here. And it's a little bit more costly for individuals than it is for institutional investors. So you might be better off just investing in a portfolio here at this point of the curve. We can easily calculate how much return a portfolio yields per unit of risk by computing its Sharpe ratio. Here we have the return on the portfolio minus the risk-free return, and this is what it's known as the risk premium of the portfolio, divided by its standard deviation. So obviously, a portfolio line here on this line would have a higher Sharpe ratio than any other portfolio here on the graph. This is another way to say that a rational investor would always invest on this line here, which is known as the capital allocation line. And our hyperbola curve here is called the efficient frontier. We used only two risky assets, SA and SB, to exemplify the concept. But you can imagine that by introducing three or more risky assets, the conclusions are still the same. What would change is that we would have many hyperbola curves here instead of just one, and generate a cloud of possible portfolios to choose from. And as we introduce assets with low correlation with the other ones, our efficient frontier, the edge of this cloud, would shoot to the left, therefore generating portfolios with higher Sharpe ratio.